Welcome to the AICPA Town Hall Series, your resource for the latest news and updates on pressing issues facing the accounting profession.
Good afternoon and welcome to the AICPA Town Hall. I'm Eric Auskerson, one of your hosts for today, and I'd like to bring up two other regular hosts right now, Barry Melanson, the CEO of the AICPA, and Lisa Simpson. Great to be with you, Barry and Lisa. And here we are, April 4th, 2024. Lisa, we've been at this for 4+ years.
4 years. I mentioned to Eric earlier in the week that this is the 4th anniversary of the PPP loan application legendary Friday night drop that the SBA did to me on my anniversary, I will say. And so that's how I remember. And we had so many Friday night drops of FAQs and forms, and boy, it's been a fun 4 years.
It's been pretty amazing. I heard, you never can believe everything from the government, but I heard they picked your anniversary on purpose, Lisa. That's, but it's been an amazing. The Town Hall series has been fantastically successful, obviously, and is obviously going in a lot of different directions. But I think it's a good time to just pause and reflect on the incredible impact this profession had on small business America at a point in time when there was incredible uncertainty because of COVID, and the effort that we all made, the organization made, but the profession made to make sure that small business America was supported during COVID to survive and thrive. And pretty much that's what happened. And I think all of you who participated in it as members of this profession should be very proud of that.
Absolutely.
Yeah, well said, Barry and Lisa. I mean, it was a defining moment. It was a defining moment for the profession, for the firms, to really, be that trusted advisor for these firms. And if you look back in the past 4 years, it started with PPP, but it just continued to evolve with other hot topics. Even in the last year, it's been all in this year, BOI, ERC, constant, discussions related to legislation, but also a lot of discussions around strategies and capabilities to advance both the practice for firms, as well as we've had a lot of great discussions related to business and industry. And as we say many times, this really helps inform us on where we need to be focused. It's a great dialogue. One of the final slides today will be, we've been at this for 4 years. We've had over 1 million views of the town hall. We have over 30,000 regular listeners. So thank you. And a lot has happened in these 4 years, and we've got another great show program in store for you today. So we can get right into it. So with that, what we'll do here is we'll kick things off with a DC and profession update with Barry, and then Lisa is going to be taking us through a technical update, and then also having a discussion with Sarah Ferentz from CNA, talking about some risk management tips during tax season. And then finally, we're going to have a good open forum, and we're going to try to get to a number of the hot questions that come in during today's show.
Thanks. I'll see you guys in a few.
Thanks, Lisa.
So Barry, kicking things off, I know you've been giving a number of presentations to firms and members, and this is a slide that you've been leveraging some recent data from the World Economic Outlook update from the IMF. It shows GDP growth by region of the world. And one thing that a lot of firms are talking about right now is with their clients, just where is growth going in the U.S. Every morning on Squawk Box over the past few weeks, they've been talking about these GDP numbers. Everyone thought there was going to be a recession sometime over the past 18 months. That hasn't happened, and the U.S. economy just actually continues to beat out a lot of these projections of slowing down. So I'll let you kind of share some of your thoughts and insights related to this data.
Yeah, the projections continue to be modest, if you want to think of it that way from a U.S. perspective. If you look at this chart, the prediction for GDP growth worldwide is a little over 3%, but about 1.7% for 2025 in the United States, which is also the Euro area, which has been having much worse numbers than the U.S. The U.S. clearly drives the world from the standpoint of the economic engine perspective. And you can see other regions of the world on this that really are predicting and forecasting much higher growth. That slowdown, if it were to happen, or it's not really a slowdown, but less growth, has some certainly ramifications on what businesses do, how much the interaction is with CPA firms. If you're in corporate America, how you advise and provide the trusted advisor role. What I've been saying is, you take this economic side, you take the election notion, and we have a record numbers of global elections for heads of states that are going on, and you take the implications of things like AI, and it will put to test our trusted advisor role. The notion that people turn to us if we're in corporate or in public accounting as to be the trusted advisor, because the amount of uncertainty, the amount of unpredictability really makes it very hard to feel confident in that. And I guess my message to the profession is, it is an unsettled time. It can go positive, it could go negative, but I think the members of the profession really need to have that confidence that we are still best positioned, even though it's a difficult advice concept. We are well positioned to do that better than anyone else, and really small business meets up business, large business counts on us to do that.
Well, thanks, Barry. And we will be having an economic update soon from one of our partners that do that regularly on these town halls. So now moving on, just here's another slide that you've been using regularly, talking about just everything that's going on with the overall environment, a lot of regulatory issues, a lot of legislative issues, a lot to keep on an ever-changing radar.
Yes, it really is, Eric. And I want to pick out a few. I'm going to come back to beneficial ownership and the tax bills here in a moment. But just to focus on the audit side of the profession, from previous town halls, that audit and assurance is the second highest growth in the profession. It is our, legislative responsibility in the public interest. We provide that as a service. We just got in the first quarter a report from the Department of Labor related to ERISA audits. You've heard us speak about ERISA audits and quality many other times during the past years. They do a study once every 10 years. What that study showed, basically 10 years ago, they showed some really significant concerns from a quality perspective. What the study this time showed is that we certainly have had improvement. That is a good thing. We have had greater alignment with the peer review process, actually identifying where there are problems. That is also a good thing. But it also still shows some pockets of concern from a quality perspective on ERISA audits, and just, making everyone aware of that. And basically where those problems persist is those firms, and this is not a size statement, I'm going to say that again at the end, those firms that do just a few ERISA audits. So it's a volume issue. It could be a big firm that does a small amount, or a small firm that does a small amount. That tends to be where the quality and compliance parts are not being hit in accordance with the standards. Peer review shows that, and the Department of Labor study does it. And again, I'm going to repeat, it's not the size of the firm, because it applies to large firms or small firms. It's really how much focus do you have, or how much volume do you have in this area. But so that's a major one that I think everybody just ought to have on the front of their thinking process as it relates to quality. But Washington and the issues of today are very complex, and let's go to the whole environment in Washington, if you will, because that's a really important part of the process. And we have a divided government, and it's even more divided today than it was just a few weeks ago. And Speaker Johnson, is literally, the Congress comes back next week, and when they reconvene, he will have a 1-vote majority in the House, 1 vote, because of resignations and the like. 1 vote is almost impossible to keep activities going in that space. And so it is, why do you care? Why do you care as a member? Well, one of the things you care about is that just makes it almost impossible for things that might have bipartisan support, might have maybe very important to us, like we've talked about the SAFE Act in the past, where we want to see the extension process for individual returns reworked to be a much simpler process. The some of the work with 529 plans and STEM, these pieces of legislation have a very, very difficult time getting through the system. The speaker is also sitting there with a threat of another vote on him staying, just like we went through two others previously with the Republican majority. So it is difficult to really see Congress making progress. You top all of that off with, this is an election year. Every member of the House is up for re-election, a third of the Senate, and obviously the White House, more intense when the presidency is up. It just limits the number of days, limits the number of activities. Now, I know some of you are saying, hey, if they're not there or they're not legislating, that's a good thing. But there are things that we want to see passed. We'll talk about BOI. There are things we want to see delayed in some cases. And those types of things make it virtually impossible to get done. So, Eric, maybe we could move forward here on the this was the point about the legislation and the one-seat majority. It really impacts the entire congressional agenda, and I think that that's an important issue. And I would just point out, when they do come back, the FISA Act expires April 19th, so that is one that they theoretically have to take action on, which will consume that energy as well. And that's really important as we move to the next slide to talk about the impact on some of these issues out here. So let me start with beneficial ownership. By now, most of you have heard there was a court challenge on beneficial ownership, a constitutionality challenge. I think it's really important to understand some of the nuances here. First off, the first nuance is FinCEN, the Treasury Department that oversees the beneficial ownership information, immediately determined or responded to that in two ways. One, they appealed the decision. Two, they asked for an injunction. And then actually, on top of the legal action, they made an interpretation that said that the stay that was presented through the court system only applies to those small businesses associated with this small business organization that filed the lawsuit. We have said to FinCEN that's an untenable position. It's got to apply to everyone. We have actually argued for, and there is a letter here that's in your materials. It's signed by, issued by the AICPA and all the states, the CPA societies. So thank the state societies from that standpoint, basically saying that given this uncertainty, BOI should not go into effect until 1 year after all the judicial activity is resolved. In addition to that, as you know, we've pushed legislation to delay anyway the 2024 implementation times. Now, the reality is that the court decision really doesn't apply to new businesses. And so you probably ought to be cognizant of the law. If you have a new pass-through entity that meets the beneficial ownership reporting requirements, you have a time limit there, you ought to file that. We are recommending for existing businesses, there's no rush. There's certainly no rush as you get through tax season. There's no rush to really address it the first thing after tax season, none of that. And we can see how this particular thing plays out. And of course, if the BOI or if the FinCEN takes the BOI position that we have, then that should all be pushed out. But that's the major issue. We are very vocal on, how this should be playing out. And let's just remember what this is about is anti-money laundering. There's certainly people who can say they'll think the court decision will be successful. There's a lot that say it won't be successful. This is a congressional act. This is not regulation. As some of you may know, there is some court cases before the Supreme Court that will decide how much leeway a regulatory agency has where there's not specific legislation. In this case, this is a piece of specific legislation. So it's a little bit different fact pattern.
Yeah, and Barry, this came at us fast as we started the year. There was a lot of dialogue back and forth. Another acronym, UPL, unauthorized practice of law. Discussions around that. And then when you just look at this category, business filing, there are solutions out there. So I think as this is sorted out by FinCEN, by the courts, we'll have time to get our arms around this. And this eventually could become an area that the firms, direct their clients on how to get it done through some pretty sophisticated technology filing services, or actually, they become part of the solution. So I think this time here and this is something we'll talk about. We will, as post-tax season, as this evolves, get up, on a town hall, talk about some of these solution players, and continue to watch how this all evolves.
Yeah, each firm will make their own decision. I can tell you, I mean, I only ever worked in a small firm. I would see this as a service line for compliance with clients, and the interpretations that we have through CNA and Aon clearly point that this falls into a covered insurance element. We've covered that in prior town halls, and I reference you back to that. There is a murkiness here because of the court case and the fact that we think the awareness is not very high and FinCEN should delay. There's all of those moving parts. There's no question about that. And you are right, there are technology capability solutions or aids, if you will. And I think small firms can, develop the service with those types of technology capabilities as well. So a lot of moving parts. We will keep it back in front and center. I think the takeaway is you don't have to be in a rush for already established entities that apply. You got all through the year of 2024. But the secondary point for new entities is probably that requirement that does kick in even with the court case. And so you should be mindful of that as clients may be forming new entities. Yeah,
well said, Barry. And then just some comments coming in. Some people are saying this is, this makes sense, and eventually, we should be doing this service. So continuing dialogue. Well, Barry, this is something that was announced this year, January 16th. People, time moves fast, but January 16th is when Wyden Smith came out with this proposal. It actually, on January 31st, it passed the House very convincingly. I think it's on like over 350 to 70. So, but then it just has stalled out. And as you talk to our DC team, the prospects are really dimming.
Yeah, it's a long shot. I remember in that January timeframe, I was in a town hall. We were talking about it, and a lot of the feedback was, "Can't you do something to get Congress not to pass any tax legislation during tax season?" And my answer was, "No, we probably can't." But the reality is, this is not passing during tax season. We got just a week or two to go. It's tied up in the Senate. It's virtually impossible to get through in that time frame. So I can't claim credit for us convincing Congress not to pass the tax act during tax season, but I know that's a relief for a lot of our members on the one hand. The overall prospects of this, every day that goes by, it's less and less and less. If there would be any amendment whatsoever in the Senate, which would take 60 votes without any amendments, which is right now pretty unlikely. But if there were any amendment, then it would have to come back to the House. And based on what I just explained with the 1-vote majority, it's very hard to see how this would pass through the process. So those of you who were concerned about a tax act during the tax season, a little bit of relief, at least from that standpoint. Obviously, the ERC changes are part of this process, or the cutoff of those. There's still the possibility that could get attached someplace, or if something moved. If you have a legitimate ERC claim, probably makes sense to go ahead and file that, given some of the uncertainty that's in that period. But unlikely this particular tax deal passes. Not impossible, but the odds are really stacked against it. Which leads us,
and
of
Barry,
course,
even though there are a number of town hall attendees were saying this isn't the best thing during tax season. There's a lot of people that were interested in a number of these different components, and I can bring up this next slide because this kind of their when you look at the Wyden Smith tax deal, it was talking about addressing some things in the TCJA bill that had expired, and now we've got 2025 quickly approaching. I think we want to bring Lisa back up here to just join in on this discussion.
So let's just connect a couple of dots. You're right. In the Wyden bill that we were talking about, there were some good things that people wanted. There were some bad things that people didn't want, some timing they didn't want. There was a lot of different fact patterns there. Some of the good things were the expiring things that were related to R&E and was a big one, bonus depreciation. And, that all of those things are now sort of hung up and not likely to get enacted, which leads you to the conclusion that if you are dealing with uncertainty with a client, you really probably ought to be in the position of filing based on the current law, not the pending legislation with extensions or whatever is necessary from that standpoint. But then that does roll into 2025. So we expect a lot of activity on taxes in 2025. Why? Because a significant number of provisions expire. We all are aware of this. TCJA provisions expire during the year, at the end of 25 for the most part. And, they deal with rates, which obviously is a big planning issue, the SALT deduction, which, if we don't have new legislation, that SALT deduction would come back on the books if you want to think about it that way. The personal exemptions on the estate planning, which would revert back to the old limit plus indexing. So it really would go from basically 14 million per person to 7 million per person, or 14 million in a combined joint property husband and wife situation. But there's also the issue of expiring the Section 179A. That would change down. You'd have phase out of depreciation. There's just NOL changes. There's a lot of things in play. Now, I don't want people to get an impression that we believe that a bill will come out in 2025 and just address these issues. If only it were that simple. The reality is that there will be, in all likelihood, a larger notion of sort of tax with a lot more things in play, of which addressing these expiring provisions would be a part of that, some or all of these provisions. And of course, it'll be a new Congress. It'll be post the presidential election. We'll see if that's a new president or the same president. And we don't know who's going to be in the majority. You can find a lot of people predict that, the House will flip and the Senate will flip. We'll go a Republican Senate and a Democratic House. It could be the same party in both places. So there's just a tremendous amount of uncertainty. But I can tell you the discussions are happening about what will Congress do and how will Congress, inside of Congress, about how they will address this issue. This will be a big issue for 2025.
So big issue for the 2024 election. This will be discussed during the election season, and there won't be legislative action in 24. It'll be in 25 because and they have to, whatever will have to get done by the end of 25 or early 26. Barry, and Lisa, there.
And Eric, the larger part of that, to just raise your point, the campaign point also will come to. There will be campaign rhetoric around a billionaire's tax, additional tax, and certain financial transaction taxes will be part of the political discussion, and depending on who wins, could be part of a 2025 tax act as well.
So I'm just going to go back, Lisa, because this question has come in every town hall since January, since the Wyden-Smith tax deal was announced. Do we file now with old laws? Assume the Wyden deal will not happen for 2023. So Barry, Lisa?
Yeah, I think at this point, it's April 4th. Congress is out for a while. We've talked about the political situation. I think we file with, based on existing law, and assume that this won't be passed. Now, that can change on the drop of a dime. Things move fast if they move, but I think you file based on these existing laws.
I agree with Lisa, and I think it's just a discussion with the client. Look, there was this legislation appears to not be moving. The prospects are very, very low. You could have had X outcome, but that's not happening. We need to move forward with the current law. I think a fairly simple explanation. And then if something does move, yes, you are in potentially a situation of amending. But, the way tax law is being crafted these days, that's a high probability in general.
Yeah, agreed.
Lisa, any additional comments on TCJA?
I think there's a lot of interest in whether or not that SALT deduction limit's going to get removed. And I think if you've dug into the complexities of the pass-through entity tax, you might be rooting for that SALT deduction to go away, or that limit to go away. So, there's going to be a lot of sausage making going on, and we'll keep you posted throughout the next couple of years as we see what's going on.
Yeah, a few SALT questions just came in here, and a lot of focus on that.
Yeah.
Well, Lisa, I know you've got a number of slides, a power session here in the technical update, and then bringing Sarah on for some good tips on how to manage some client situations. So I'll hand it off to you.
Thanks. I'll see you at Open Forum. All right, so we're going to start with one of our everlasting favorites, the Employee Retention Credit. And we've just ended up the ERC Voluntary Disclosure Program. So it closed on March 22nd, but it's really important to know that the withdrawal program is still available. So that is for your employers who filed an ERC claim, but in hindsight don't feel they qualify for it. So they must have either not received their refund or not cashed a check if they got it. And they must withdraw the entire amended payroll tax return. So that is an option for if you had a client who's kind of changed their mind about it and wants to avoid perhaps, an inspection of their claims. So over the last couple of weeks, the IRS has announced some pretty big numbers around ERC, and they're saying that there's been about $1 billion in potential savings from erroneous ERC claims through either enforcement. We know that they've really picked up their enforcement activities around ERC, and also got good take up on both the voluntary disclosure program and the withdrawal program so far. So they did say, which I thought was an interesting number, there's another $3 billion in ERC claims that are being investigated. So a lot still going on. Barry talked a little bit about the should you file or should you not file based on the proposed cutoff date in the Wyden-Smith legislation. We've talked about the fact that that's not really moving anywhere, but you can still file ERC now. I think there's been some confusion about that because of the moratorium that the IRS had announced back in September. That moratorium was on their processing of ERC claims. So they had a big backlog in their systems. They reported that they've processed $1 billion of claims that were in that backlog, but the moratorium is still in effect. They have said that it could be lifted late spring. I think we're getting kind of close to late spring. I guess we're a couple weeks in, but that they are continuing their additional scrutiny around the claims that have been filed. Let's see if there's anything else on that one. So, an important reminder, if we can skip to the next slide, because I want to make sure that we call this out. 2020 ERC claims can be filed until April 15. So just 11 more days. If you've got a 2020 claim, that still needs to be filed. So again, as a reminder, the moratorium is on the IRS processing. It does not impact your ability to submit claims. So that's our ERC update. And then unfortunately, we've got more news around natural disaster relief that the IRS has granted. And I've got those states listed for you on the next slide. So we've got new disaster relief on filing dates for Alaska, for parts of Alaska, I should say. And on the next slide, Eric will also show that there are some parts of Hawaii that now have this tax relief from the disaster situations. And just announced today there are parts of Maine that are now qualifying for disaster relief from flooding that happened back in January. So that extends their dates until July 15. So a lot of news in this area, and I know that it's probably hard to keep up with, especially if you're working with clients in different states. So just a reminder, we have a disaster relief resource center that you can check to make sure that you're keeping up to date on all of those different situations. A couple of tidbits from the IRS about some changes or some programming issues around Form 1065. So the IRS has announced that there's an error in actually how the K-1 programming is working. And I've got the details for you on the next slide. So basically, Form 1065 filers should be able to use code ZZ, which means other, in box 20, but there's an error that actually blocked that from being allowed. So the IRS came out and announced, hey, we know this is an issue. We apologize, but extend the returns and defer filing until June 16. So hopefully if you were impacted by that ZZ filing or programming error, you were made aware of that. Also, this week, the IRS launched their Dirty Dozen annual listing of the evolving scams that they want taxpayers to be aware of. Their first one was phishing and smishing. So phishing and smishing are both designed to try to get taxpayers to divulge personal information. The next Dirty Dozen on their list was employee retention credit promoters. So they're still very skeptical of a lot of the aggressive ERC promoters that we've seen and that our clients are dealing with. So they've issued another reminder about that. They've also issued a reminder about quote unquote helpful scammers who are trying to offer to set up online accounts for taxpayers, and in the process are getting taxpayers to give up their dates of birth, their socials, and all kinds of information so that they can then use those online accounts to file fake tax returns, get fake refunds, and things like that. Other items on their list so far are false fuel tax credits, compromise mills. So providers that are saying that they can get you an offer in compromise, but it's legally required. So some scare tactics around there, and then fake charities, which we've heard about in the past. So just a good reminder about what's going on with your clients and what kinds of scams they might be getting subject to. I know I get a smishing campaign every day, it seems, and they really do look real. They've gotten so much more sophisticated, and they are evolving, as the IRS has said. So again, just be thinking about how you can alert your clients to these potential scams that are out there. So with that, I'd like to bring up Sarah Ferentz with CNA. Thank you, Sarah. I'm so glad to have you back. I think a lot of folks on the Town Hall community know you, and we're going to get to a really important topic for the last couple of weeks of tax season that I'm so glad you're able to bring us these examples that we're going to go through. So welcome back to the Town Hall, Sarah.
Thank you, Lisa. I'm excited to be back, and 11 more days left until the filing deadline.
Yep. So let's dip into some of the scenarios that Sarah's brought to us. And I can tell you, I identified with all 4 of the scenarios that we're going to go through. But let's start with the first one, Sarah. The client who you've done the return for 30 years. It's April 4th. They haven't contacted you. They haven't responded to your attempts to contact them. You're worried. You don't want them to miss the deadline. So what are you going to do?
Yeah, this is the AWOL client. And these scenarios are based on situations that we've heard from practitioners over the years. Every year at this time of year, we see these kinds of questions come up. So, for the AWOL client, even though you've prepared their return for 30 years, I think we would argue that, are they really your client? They haven't contacted you. They haven't responded to your attempts to contact them. So is this really something are they really your client? I would say no, but I think to be on the safe side, you should send them a communication, always in writing. We love documentation, and tell them that you haven't heard from them. You've tried, but they haven't contacted you. You assume that your services for this year aren't needed, and that the taxpayer will find someone else to prepare their return. And then remind the taxpayer that the returns are due to be filed or extended by the 15th. And that if they don't do so, you provide the consequences. The IRS may assess penalties and interest, and the taxpayer will be responsible for those items. So sending those kinds of communications to remind the client of their taxpayer of their filing obligations and what could happen if they don't meet those obligations is always a good practice. And while we empathize and understand the caring about the client, the taxpayer, I keep calling it a client. It's not a client. The taxpayer, don't extend their return without their permission. You can't care more about their compliance requirements than they do. They are the taxpayer, not you. And so certainly, it goes without saying you should not extend this taxpayer without any contact from them.
I love my tax Twitter community, and this situation came up just this week in tax Twitter, and they were talking about examples of, we care so much about our clients. We don't want anything to happen to them. And so someone actually went and knocked on the door of a client that they'd had for 20 years.
Yeah.
And the client was just too embarrassed to say, I'm moving on to a different preparer.
Wow.
And so I can so empathize with this, because we do care so deeply. But to your point, they're not a client, they're the taxpayer. I just think this one's, heart versus head, and you got to mitigate the risk with your head.
Yes, absolutely.
Yeah. So the next one is our ghosting client. So the ghosting client has engaged you to prepare the return. So they're a client, but now you're not getting any information from them. So they've just completely ghosted you. What do you?
Yeah. Or you've asked them questions, or they've provided piecemeal information. Regardless, there's some outstanding information or questions and things that have not been resolved. And we're getting close to the deadline. And so what do you do in that situation to make sure that the taxpayer is helping to meet their compliance requirements, and you're assisting them with that, but also making sure that you're not so compressed and rushed for time that you make an error in the process. So again, going back to communication and documentation, you want to send them some sort of traceable communication. You may have already set a deadline for the client to provide you with their information, and that time has passed. I know for myself personally, we had to get our information in by early February, and we owe an extension. So you've probably already set that deadline. You can tell the client that deadline has passed, or if you haven't set it, give them the absolute drop dead date by which they need to provide their information or respond to your questions, or whatever the case may be. Set the boundary, and then, and that deadline, and then stick to it. And tell the client that, you can help them file an extension of time to file, but they are going to need to confirm that they, want to extend, and also request that in writing and sign the form 8868. And then also in that communication, again, note the consequences for the client's inaction. If they don't provide their information by the date certain that you've provided them, that their return is not going to be filed by April 15th. If they don't confirm and request an extension in writing, then the extension is not going to be filed by April 15th. And then also, if they're not going to file or extend by the 15th, they could be penalized, and they're going to be responsible for those amounts. And then also confirm, or make sure you communicate that while the extension provides an extension of time to file, it does not provide an extension of time to pay. And the client could face underpayment penalties if they don't pay the requisite or the appropriate amount. And then if if the client doesn't want to extend for whatever reason, then you give the client their options. The client, if you don't want to extend, you can provide me with your information by whatever date that might be. And I would argue it probably should be by end of day tomorrow, potentially, in order for you to prepare the return on time. Provide the information on time, go find a new CPA, or, it's okay to extend. Everyone, people do it all the time. It does not increase your chances of audit or whatever the client may think the case may be.
And there's so much fear, with some clients around extending. They think it's going to make their chances of getting audited more. We have some resources in the Tax Resource Center to help you communicate with clients about extensions and to just kind of reassure them that it's not a big red flag just because you go on extension. It's a normal process. Heck, I extend my return all the time.
Yeah. Likewise.
Yeah. All right. So now let's go to another fun scenario. The client who disagrees. So you've given us one example. I'm sure there are lots of others.
I mean, it's really where there's a difference in opinion regarding a tax position. You may feel the tax code supports one position, the client may think otherwise or disagrees, and maybe the position that you think is most appropriate results in a tax liability that the client can't pay at this point, and they want to and they think a different position would be more appropriate. And this is something, these are the really sticky situations when it comes down to the wire and you're trying to figure out what to do here. And really, first and foremost, both the, AICPA tax standards and the IRS guidance truly say you can't sign a return that includes positions that that can't be supported. So what do you do here? Really, first and foremost, this is the taxpayer's tax return. So they're ultimately responsible for the positions taken on them, but you want to make sure that you're in a position that you have some level of comfort with regard to signing it. So you can, provide the client with their options, in writing, and then tell the client to choose whatever option they think is best and try to get that choice in writing as well. So maybe the first option is to provide additional information to the CPA that better supports the position that the taxpayer thinks is appropriate. Maybe there is something, I don't know, but presumably they would have provided it originally, but maybe not. So maybe there's more information out there that they need to provide to support their position. Maybe it's agreeing to file the return with a position that the CPA is comfortable with, whether it's filing with disclosure, making sure that you provide the pros and cons of each option. Maybe it's, maybe you just can't come to any sort of agreement and you're just butting heads with the client. And maybe the client needs to find another CPA to sign that, to prepare the return and sign it. That may include the client's position that you're just not comfortable with and you just can't resolve to get comfortable with. And then, if you're still in a disagreement and you maybe decide with the client to extend that return, then the question becomes, well, what about, the amount, the extent, what about the extension payment? What we would suggest is that you inform the client of the, extension amount in writing. And here's the amount that you suggest. If the client decides to pay less than that, then advise the client that the IRS, may ultimately disagree with that position. And the client may owe more, and the client may be assessed interest or maybe assessed penalties, maybe interest as well. And then the client's going to be responsible for those amounts. So I think, if you think of a recurring theme in these last few scenarios, it's really, it's documentation, it's communication to the client, it's informing the client of their options, and then also informing them of the consequences should they fail to comply with whatever deadline or requirement that they might have. Always good tried and true risk management advice. Documentation.
And Sarah, I know in the past we've talked about documentation. So if you're not doing this over email, at least document the conversation and put it in the file so that you've got something in writing that supports the fact that you had these conversations. This is what the client decided, and this was your response.
Right. And I think, if you have time to prepare a file note to your work papers, then I would argue you probably have time to write that email to the client, and always that the communication with the client is always going to be better evidence to support a conversation that happened than your file note. So I think that would be our preference, would be, a quick email summarizing the discussion back to the client. That would always be our preference.
That's a great point. See, that's why we have you on this segment, so you can keep me in line. All right, we have one more, and I know this client. This is the delinquent client. You've gotten their information. You've prepared the return. They have signed their e-file, but they have not returned the engagement letter. They haven't paid you the fee. So it seems like they might have you over a barrel. What are you supposed to do?
I would agree. I think you're stuck between a rock and a hard place here. And every year we get calls from CPAs saying, my client hasn't paid me. Can I hold up their return until they pay me? And our first question is, have they signed the 8879? And if the answer is yes, then we unfortunately say, you know what, you can't hold up the return. There's IRS guidance that says you need to file that return timely, and IRS publication 1345 talks about it, timely is really within 3 calendar days. So it's unfortunate. Best advice here is to avoid getting in that situation in the first place. So you've got time now, between now and the 15th, start getting the signed engagement letters back if that's what you're missing. Start getting the fees if you require payment prior to filing of the return, and we would suggest that you at least get a chunk of it up front rather than trying to send a bill after the service has already been delivered. But hopefully you're avoiding those situations in the first place. But if you do find yourself in that unfortunate situation, if you've got the 8879, you need to file the return.
Okay. Great advice. And just as a reminder, we do have those best practices for you. We've got, again, the information I mentioned around tax returns, engagement letters, powers of attorney, and other resources available to you. Sarah, that's been great. Anything else? Final closing thoughts before we scoot on into open forum with 11 days left?
Yeah. We have seen an uptick in the last couple of years of claims that relate to untimely filed returns. So, either a return was missed or a return was filed late. And these are, generally speaking, avoidable mistakes. And one of the best ways to help avoid an untimely filing error is to monitor completion every day between now and the 15th. Are there any returns that are still outstanding that need to be completed? Is there anything that is slipping through the cracks? And making sure that you're not getting to the 14th or the 15th and trying to file or extend a bunch of returns in a flurry. The other thing we would suggest is not only monitor your filing, but also monitor and make sure that the taxing authority has accepted those returns, especially those filed right before the deadline. You push send and file, and that last one at 11:59, and then walk out the door. Stay around a little bit longer until you actually get the acceptance to make sure that it actually went through. Because we do see claims that arise, and taxpayers who have been penalized because they have been late, because the taxing authority didn't actually accept it and it needed to be refiled. So those kinds of things definitely come up. The other thing we see at this time of year, and it happens kind of right before March 15th and it happens right before April 15th, is an increase in e-file rejections. Potentially, that's only noticed, when the client, the CPA goes to file a bunch of returns. And when you see an increased number, an unusual number of e-file rejections, it usually is pretty indicative that some sort of data security compromise has occurred. And that is unfortunate. The first thing you should do is also, contact the IRS to let them know about your eFIN compromise, but also contact your cyber carrier because your systems have probably been compromised in some way.
And that would not be the right way to close out tax season. So let's hope that's not going to happen. And also, I'm just going to say, can we make a commitment that we're not going to file returns at 11:59 p.m. on
Yes,
April?
that would be great.
Let's not do that.
How about another commitment also that we will not file without a signed 8879 or the 8868?
Okay, there we go. Good advice. Good advice. All right, I have seen out of the corner of my eye thousands of comments coming through. So let's turn it back over to Eric and see what we've got to talk about in open forum.
Yeah, well, we've got plenty to talk about. So we'll first just do a segue question based on that last session. A lot of great feedback. One of the top questions that came in was related to the ghosting client, and it was if they've signed an engagement letter, why should you not just file an extension? There could have been a health issue that came up, some issue that came up. So maybe there's number of comments that came in there saying, I really would just like to file an extension in that circumstance.
Well, if your engagement letter states the fact that maybe it's already a planned extension, maybe this is, this client's going to be extended every year. You put that in the engagement letter, that's the agreement. But I believe they still need to file our signed form 8868 prior to doing so. So that's something that you would want to get from the client in writing, get them to sign before you do that.
Okay, thank you. Well, Lisa, I'll let you dig in a little bit there. I'm going to step us back. Because there's some broader questions that have come in. Barry, since the last town hall, there was another private equity, maybe it was right around the last town hall, another major private equity investment, the one that was placed into Grant Thornton. So as you've been talking about this, the biggest one so far started the year with Baker Tilly, and then an even bigger one with Grant Thornton. So the question is just thoughts on that related to the profession, related to client services.
Well, the first point I would make is let's not forget there's a lot of traditional mergers and acquisitions occurring. We tend to not see those reported in the news and things of that nature. And so let's remember that there's a lot of different models that are in play out in the marketplace. For instance, Farvis combined two big traditional firms to create a multi-billion-dollar firm, et cetera. So related to both of those, Baker Tilly and Grant, they are big transactions. There's no questions about it. And where it goes from here, I think is going to be interesting. I think the point that I would make is that what we're looking at in that larger tier, below the big four to, let's say, the $1 billion mark, is we're looking at about 13 firms that have $1 billion or more in revenue. And they're sort of back to that first economic slide. What does the economy support? How do they get their growth? How do they get the technology efficiencies? How do they get the staffing efficiency? What implications does things like AI have on staffing? And I think we will continue to see different models experimented with in the profession. Where the ESOP at BDO was a big news item, last year. And if the BDO folks would be here, they would be saying how much they believe that's the model for the future. I think we're in a period of pretty significant transition for the profession. The reality is that based on different estimates, the collective fees from CPA firms in this country are something around $145 billion on an annual basis. And, when you look at those big four plus the next 13 that are all $1 billion and above, you're in excess of about $120 billion. And so as the economy ebbs and flows, the ability to produce annual growth in each one of these versus consolidation that produces economies of scale is a factor that is on people's minds. And so I think part of that is there. I think it's also part of how do you expand into other services, what technology, what investment is necessary into the other services. We know, for instance, CAS is something that has been embraced for a long time in smaller firms, Eric, but today is really being embraced in larger firms as well. And so how do you go to market in those particular areas? I think it's just reflective of a lot of moving parts in the profession right now. And I think the key is in all these alternative firm structures is the commitment to quality, the preservation of the assurance, the structure that protects the independence from that standpoint. And every firm has to agree to do that. And I do think that we will continue to see these models evolve. Some of these will prove to be successful and some probably will prove to be not successful. And it's part of really a success story of growth in our profession that these different models are permeating and that private equity is interested. But it is also something that we have to watch and make sure that it continues to support a prosperous profession. Last point I'd make, tax is very, very critical in this process. And Sue Coffey and I speak a lot to these firms and to the private equity groups. This profession has a marketplace predominance in tax, and it's very important that through these different structures that we maintain that. We have a regulatory requirement in audit, we have a marketplace developing permission in CAS, and we have a marketplace permission in tax. We need to make sure on those marketplace sides that we continue to own that space or have a big footprint in the profession in that space.
Well, Barry, I'll make a quick comment here, and then Lisa, I know you've been looking at the questions. Let you, maybe grab a final question for you and Sarah. And one thing when we're talking to the firms, Barry, and that have had private equity investment, and you think a little bit about this, it's the top 100 firms, overall grew at 12%, and some of that was due to M&A. But it's the market, the firms, they're growing, the value's increasing. Are related to what they're providing to the clients. And that's what the private equity sees is the opportunity to accelerate that. And when we're in discussions with the firms, they're working on, solutions, they're working on scalable, repeatable processes. And this actually can happen with firms of any size. So it's an exciting time. And I think this is going to, offer, more capabilities, more investments in technology. And the great thing about this is private equity is coming in due to the health of the firms and wanting to accelerate that health. Sometimes they go into retail, so they go into retail stores and things like that because they're distressed markets. This is not a distressed market. So Lisa, let you grab a question here, then we can move into closing remarks.
This will have to be a quick question, but Sarah, it is for you, and you can take a pass if you want to. But it's similar to the first question that Eric asked. If you've got a client that you haven't heard from, why can't you extend, even if you don't have a signed engagement letter or anything else? So a little bit of a different take. And what I've seen other practitioners talk about is that the client has already filed their return somewhere else, and maybe they've made elections on that return or something like that. So it's messing up if you go ahead and file an extension and they've already filed the return.
Yeah, that could be the case. There could also be, you haven't received their permission to use their tax information in that way. If you are extending their return without their permission, you could presumably be violating, Revenue Code Section 7216, and there are penalties. There are penalties that the CPA might face for doing so. If you have not heard from them, they are not your client, and you should not be extending their return without their permission.
Again, I know that's really hard to accept. But again, these are risk management techniques that Sarah's given us. So I appreciate
it's a no good deed goes unpunished kind of
That's
scenario. And believe me, I was at my firm for 15 years. I still continue. I have always delivered client service in my entire career, whether it's CNA or when I was at my firm. I understand the need to serve clients, but you have to take care of your number one client first, which is your firm.
Yeah, good advice.
Well
All right,
said.
Eric.
Yeah, thank you, Sarah. Great comments, great insights, a lot of good feedback, Barry. Thank you for the the kickoff overview and for participating here in open forum. Look forward to having you back on the town hall sometime very soon. Thank you.
Thank you.
So we've just got a couple of closing slides here and that Lisa and I will do and wrap up here on time at 4 p.m. So we've got a great JFA issue out on what's happening with Gen AI, a lot of different insights and techniques that you can take advantage of. So all of that's highlighted here. We also have a 30-page Gen AI toolkit that we put together that talks about a lot of different use cases. So those two documents can definitely help you get your arms around what's happening with that very, very exciting technology. Here's a couple of other trusted advisor types of educational opportunities related to the CAS area, related to some important elements of the Secure Act. And here, just as we kicked it off, Barry and Lisa, just thanking the town hall community for 4 years and 1 million live on-demand participation. It's just fantastic. We got more to come as we move forward for the next town hall, which will be after April 15th on April 25th, and the next one after that, May 9th. We have published the calendar as well. So Barry, Lisa, any final comments?
Great discussion as always. Thank you all the participants. Good luck through those of you in public practice and in tax season. Good luck with that. Hopefully we've provided some help here with some of the discussion and look forward to seeing you soon.
Thanks, everyone.
Thank you.
Thank you for your participation. You can now subscribe to the AICPA Town Hall series on your favorite podcast platform, as well as watch archives on YouTube and AICPA TV. Tune in for live broadcasts Thursdays at 3 p.m. Eastern Time.